My name is Michael Grandy. I'm a professor at Providence College teaching managerial accounting, and today's presentation is going to be about cost, volume, profit. And this is from chapter 18 of the Kimmel book. So the first problem I want to look at is problem 18, that's the chapter, point 1a. So it's problem 1 from chapter 18. And let's read the problem. It says, the controller of Rather Production has collected the following monthly expense data for analyzing the cost behavior of electricity costs. So when you look at your textbook, you can see they have January through December listed. They've got the total electricity cost by month and the total machine hours correlated by month and dollar amount. And what they've done here is, as you know from cost, volume, profit, we want to determine a cost formula. We want to be able to estimate electricity costs on a go-forward basis. And they have determined that these costs are neither variable nor fixed. So they are a mixed cost, that's an M, mixed cost. So we need to find a way to come up with a formula. And what we're essentially doing is we're going to use the high-low method to come up with a formula. So item A asks you determine the fixed and variable cost components using the high-low method. So the first thing you want to do is look at the data, and you want to determine which is the high activity month and which one is the low activity month. So the high activity month is going to be December, where they have 720 machine hours, and the low activity month is going to be January, where they have 300 machine hours. So then what we want to do, the first thing we want to do is calculate the variable cost per unit, and that's going to be the change in dollars divided by the change in activity. And that's essentially the high minus the low, right? High minus low dollars and high minus low activity to come up with the variable cost per unit. So the high dollars is $58.60. The low dollars is $2,500. So the change is $33.60. We're going to divide that by the change in activity. The high activity is 720 machine hours. The low is 300. So we have a change of 420. That's going to equal $8 per machine hour. The variable cost is $8 per machine hour. So the next step we want to do is we want to isolate the fixed cost. So we're going to look at we can look at just a high level. So we'll go to high, and they have a total cost at the high level of $5,860. So that's the total cost. That includes both the variable and the fixed. We want to isolate the fixed cost. So we're going to subtract off the variable cost. So at the high level, we have 720 machine hours times the $8 per machine hour, which is my variable rate. The variable cost included in the total cost is $57.60. Therefore, the fixed cost equals $100. You can do the same at the low level and come up with the same $100. So they are then asking for you to come up with a cost formula. And that cost formula to predict is total cost equals fixed cost plus the variable cost. Fixed cost is $100 per month, and the variable cost is $8 per machine hour. So let's take a look at that first question where they ask, what electricity cost does the cost equation estimate for a level of activity of 500 machine hours? So for 500 machine hours, the total cost is going to be $100 plus $8 times 500 machine hours. So you can see this is going to be $4,000 plus $100. Total cost $4,100. That's item B. Item C is another exercise, just trying to figure out the cost at $700, but that's pretty straightforward. Let's look at another problem. Let's take a look at, this is going to be problem 18.2. And this gets a little complicated, so you may have to read it over a couple of times. So it says, Vin Diesel owns a barbershop. He employs 4 barbers and pays each a base rate of $1,250 per month. One of the barbers serves as the manager and receives an extra $500 per month, which are indications. When they say per month, that's an indication of a fixed cost. In addition to the base rate, each barber receives a commission of $4.50 per haircut. That's a variable cost. So when it says per month, that's an indication that it's a fixed cost. And when it says per haircut, that is an indication of a variable cost. Other costs are as follows. Advertising, $200 per month. That's a fixed cost. Rent, $1,100 per month. That's a fixed cost. Barber supplies, 30 cents per haircut. That's a variable cost. Utilities, $175 per month plus 20 cents per haircut. So that's clearly a mixed cost. And then magazines, $25 per month. Another fixed cost. Goes on to say, Vin currently charges $10 per haircut. That's the sales price per haircut. So item A is asking, determine the variable cost per haircut and the total monthly fixed cost. So it's asking you to identify variable costs and fixed costs. So the first variable cost is we have the barber's commission, which is $4.50 per haircut. The supplies, which is 30 cents per haircut. And the utilities, the variable portion, because that's a mixed cost, at 20 cents per haircut. So you can see the variable cost is $5 per haircut. On the fixed cost side, we have the salaries, which is 4 salaries times $12.50, which is $5,000. And then we have the manager, who gets a little extra, right? He gets another $500 per month. Fixed cost, right? Per month. Variable cost per haircut, HC haircut. We have advertising, which is $200 per month. We have rent, which is $1,100 per month. We have utilities, which is this is a mixed cost, remember, but this is the fixed portion of it, $175. And then we have magazines at $25. So the fixed cost is $7,000 per month. The fixed cost is $7,000 per month. So what we see here, their cost structure is $5 per haircut plus $7,000 a month. The next question they're asking you is compute the break-even point in units and in dollars. So I like to use this formula. So break-even point in units equals the fixed cost divided by the contribution margin per unit. So in this example, the fixed cost, we just calculated them to be $7,000. But what's the contribution margin per unit? It's the sales price, which they said is $10, less the variable cost, which we just determined to be $5. So the contribution margin is $5 per haircut. Break-even point in units. $7,000 divided by $5 per haircut. So how many haircuts do they need to sell, to service, to break even? So it's $7,000 divided by $5. They need to service 1,400 haircuts in order to break even. That's break-even point in units. The next question is asking for break-even point in sales dollars. Break-even point in sales dollars. So that formula is fixed cost divided by the contribution margin percentage, or the CM ratio. So again, we know what the fixed costs are. They are $7,000 per month. But what is the contribution margin ratio? So let's remember the sales price is $10 less the variable cost of $5 equals the contribution margin of $5. This is in dollars. On percentages, the sales number is always the 100% number. So the contribution margin is going to be the contribution margin divided by sales. 5 divided by 10. The contribution margin ratio is 50%. The contribution margin ratio is the contribution margin divided by the sales price. Is 50%. Divided by 0.50. They have $14,000 in sales to break even. The break-even point in sales dollars is $14,000. Let's look at the next question. Well, the next part. So they're asking here, they're asking C to prepare the CVP graph. We don't want to worry about that. But we want to look at D. And D says determine net income assuming it's 1,600 haircuts. So what is net income when they sell 1,600 haircuts? So sales, it's going to be $10 per haircut times 1,600 haircuts equals $16,000 in sales. Less the variable cost. And we know the variable cost amounted to $5. And remember, if sales are based on 1,600 haircuts, the variable cost must also be based on 1,600 haircuts. That's $8,000. Contribution margin is $8,000. And the fixed cost, which we calculated earlier, remember the definition of fixed cost, total cost stays the same regardless of activity. So whether they have 1,400 haircuts or 1,600 haircuts, the fixed costs stay the same at $7,000 per month. Therefore, net income is $1,000. So that's problem number 2 from chapter 18. Let's look at another problem. And this is going to be problem 3. And there's a lot going on in this problem as well. So, you're going to have to work these over a little bit and obviously replay this video if you have any questions. So this is going to be problem 18-3. And let's read it. It says, Jorge Company bottles and distributes Be Light, a diet soft drink. The beverage is sold for 50 cents per 16-ounce bottle to retailers. For the year 2022, management estimates the following revenues and costs. Sales, $1,800,000. Direct materials, which is a variable cost, $430,000. Direct labor, which is also a variable cost, $360,000. And then they've got manufacturing overhead, which is obviously a mixed cost. They give you the variable piece at $380,000 and the fixed piece at $280,000. They go on to say that selling expenses are also a mixed cost. The variable portion is $70,000, the fixed portion is $65,000. And again, their administrative expenses is also a mixed cost, has a variable and a fixed component to them. So the first question says, prepare the CVP income statement for 2022 based on management's estimates. Show column for total amounts only. So the income statement is going to look something like this. We're going to have sales, which is $1,800,000. Now, it's important, we got to figure out how many units that represents, because at some point in time, we're going to want to be able to know the number of units to calculate our break-even point. So here, we know that the sales price is 50 cents. So some number times 50 cents equals $1,800,000. So they're going to sell 3,600,000. That's 3,600,000. I'm sorry about that. I can't quite read that. 3,600,000 bottles of diet soda. At 50 cents each, they have total revenue of $1,800,000. So we want to now then subtract the variable cost. And the first one is cost of goods sold. And cost of goods sold, CGS, is made up of direct materials, direct labor, and manufacturing overhead, but only the variable piece. So direct materials, from the piece of information they gave you, is $430,000. The direct labor is $360,000. And the variable manufacturing overhead is $380,000. This totals up to be 1170. $1,170,000. The next variable cost is selling expenses. Again, the variable portion only at $70,000. And they have an administrative portion. Again, the variable portion only at $20,000. So we have total variable costs of $1,260,000. Therefore, contribution margin, right? Sales minus total variable cost of $540,000. That's $540,000. We then need to subtract our fixed costs, and those fixed costs represent manufacturing overhead, which is $280,000, selling, which is $65,000, and admin, which is $60,000, for a total of $405,000. Now that's an important number because we're going to need that later on. So let's remember that the fixed cost is $405,000. contribution margin minus the fixed cost equals net income, and this is $135,000. So when they sell 3,600,000 units at 50 cents, having sales revenue of $1,800,000, they have net income of $135,000. The next question is asking, says compute the break-even point in units and in dollars. So again, this is the format I like. Break-even point in units equals fixed cost divided by this contribution margin per unit. We just calculated the fixed cost at $405,000. But what is the contribution margin per unit? So the contribution margin per unit is going to be the sales price at 50 cents minus the variable cost equals contribution margin. But what is the variable cost? Well, if you look back, we just calculated the total variable cost to be $1,260,000. We calculated. I'm going to pause for a moment. I want to check a number. So the total variable cost, right? Total variable cost is $1,260,000, and the number of units sold was 3,600,000 units. So what are we trying to do? We're trying to come up with variable cost per unit. So you take the total variable cost divided by the total number of units, and you're going to come up with 0.35. $1,260,000 divided by 3,600,000 units. The variable cost per unit is 0.35. Therefore, the contribution margin per unit is 15 cents. Total fixed cost of $405,000 divided by 0.15. You have a break-even point in units of 2,700,000. That represents units. When they sell 2,700,000 units, net income equals exactly 0. Next question is asking for the break-even point in sales dollars. So the break-even point in sales dollars is going to be the fixed cost divided by the contribution margin ratio, the contribution margin percentage. So the contribution margin percentage, the CM percentage, equals the contribution margin divided by sales. We can do this on a total dollar basis, and we can also do it on a per unit basis. We know that the contribution margin per unit is 15 cents, and we know that the sales price, SP, is 0.5. So we know that the CM percentage is therefore 30%. Divided by 0.30. Break-even point in sales dollars, 1350. That's the break-even point in sales dollars. Let's look at item C. Item C is asking compute the contribution margin ratio in the margin of safety. So we've already calculated the contribution margin ratio, which was 15 cents. That's my contribution margin divided by sales of 0.50. We came up with 30%, which is my CM percentage. So now they're asking for the margin of safety. And the margin of safety is going to be sales dollars over break-even sales divided by actual sales. So the sales over break-even sales, right? So we calculated the actual sales to be, I'm looking for some room here, so I'm going to have to erase this top part here. We had actual sales of $1,800,000. We have break-even point sales dollars at 1,350. So we have actual sales in excess of break-even sales of $450,000. So this numerator is going to be $450,000. That is the sales dollars over the break-even sales, $450,000, divided by the actual sales of $1,800,000. Therefore, the margin of safety is 25%. Let's look at item D. Item D is asking you, what do gross sales need to be? Let's read the specific question. Determine the sales dollars required to earn a net income of $180,000. So target profit is $180,000. So that formula is very similar to the break-even point formula. So target profit equals fixed cost plus target profit divided by the contribution margin percentage. Fixed costs, which we already calculated, $405,000 plus the $180,000 of target profit, divided by the contribution margin ratio, was 0.30. Target profit, sales dollars, is going to equal $1,950,000. So what that means is when the company has total sales of $1,950,000, net income will not equal zero. It will equal $180,000. So that's all I have for problems for Chapter 18. Thank you and good luck.